It sounds like we've discussed whether or not direct listings could be a real trend. It sounds like you think it has legs.
I do. I'm a strong believer in direct listings. When you think about the IPO process today, it's really conflating two functions. One is providing a currency for old investors and new investors, and two is to establish price. With a direct listing, you separate the functions. You let the market determine the price, not the IPO process, not the restricted roadshow price discovery process, but the whole market discover it. So I think that's a great separation. I think you'll see this as a trend line going forward.
How much of the calculus do you think pivots around the fewer fees and less of the just onerous roadshow process? How much of the calculus is that?
I don't think it's that. Clearly, companies who have a balance sheet today should be thinking about this. But I think the fundamental problem you can solve is when you have an IPO go up 300%, then clearly the selling shareholders, the company's not happy. If the IPO goes down 50%, then the new investors are not happy. I think with a direct listing, you have the possibility of discovering price in a more rational fashion, right? You bring the company public, you let the market, not the roadshow, discover that price, and I think that's a better way to handle it. More democratic, certainly.
So what would you say to people who have the fear that, yeah, maybe it's more market determined, but it also means no lockup. So insiders can sell on the first day. Could be very turbulent. You don't have the underwriters propping up the stock. You know, some of the fears that you get around trading that you don't get in a traditional IPO.
I certainly think that's a consideration, but that consideration is one of many. And I think the greater good is you let the market determine the price. I certainly don't think many of the CEOs and senior management will be selling into the direct listing, but that can happen. But again, if the public is allowed, don't forget the roadshow, you visit 30, 50, 100 different investors. Here, when you have price discovery happening through the exchange, you let all investors on a global basis come in. That's a better outcome.
How much volume do you think you need to get a real sense of price discovery day one? Because I know that's been a bit of an issue, Bob, in terms of Spotify, and now with these guys at least trying to get, and they don't know how many sellers they'll get, but get enough to really aggregate a true price.
Yeah. Well, I certainly think the opening of the stock is the most volatile and the most fraught with peril. But you have to understand, again, that we have situations where IPOs going up or going down a large amount. I think you'll see over time. We do not have enough data points now, but I believe the data will reveal over time direct listings will give you a better opening day price than you'll have when you just do it through a traditional roadshow.
Bob, how is that not an indictment of the bankers and market makers whose job it is to find that price discovery?
It's not an indictment of that. It's an indictment of the process, right? A roadshow, I've been on a few myself. They take a while, right? You're involved with for 2 weeks. You meet 8, 9, 10 different investors in a day, one-on-one meetings. You have a group lunch, and you work hard at it. But understand, it's still a small number. When you count up the number of investors you meet, it's probably like 100, not thousands, right? So it's not the investment banker's issue. It's just the fact that you are constraining the number of people who can be involved with that price discovery process. When you see a company like Beyond Meat go up 300% or 200% in a given day, obviously investors who wanted to pay more for that stock were not in that roadshow process. Now they'll have the ability to participate in it quite directly.
But it's not a capital. I mean, if you need to raise capital, though, what are you supposed to do?
Well, you do that second stage.
Yeah,
that's exactly what I'm saying. You separate the two functions, right? You do the public action, let the market determine the price, then you, the company management, the investors can see what that price is. You don't have to guess at it, right? When you go public, you sit there the night before wondering what the price will be the end of the first day. You don't have to worry about that. You then raise capital 3, 6, 9, 12 months afterwards when you have a somewhat mature price and you know exactly what you're getting into. I think you'll see a lot happier people. Obviously not as happy as the person who had their stock go up 300%, who was a new investor, but you certainly have a fairer process in that when you basically separate the two functions.
One of the narratives on some of these IPOs has been, Bob, just how long it's taken them to go public. The fact that, in 1999, the average time for a tech company to go public was 4 years. Now that's 11 years. Maybe we shouldn't go back to 1999 levels, but do you think this will help decrease that time period, having this sort of enticing option to go public in a different way?
Well, one is, my opinion, you want to go public when you have a fairly mature business model and great visibility to what your future involves, right? When you go public, you're facing what I call an endless series of quarters where investors expect you to deliver. So the fact that you wait a little bit longer, develop the business model, have a clear strategic direction, I don't think is a bad thing. So I don't know if 11 years is right, but I would certainly say 4 years is probably too soon. So I'm not in the camp that says, okay, we got to make these companies come public sooner. Public investors, always reward consistency of earnings. And when you can do that, or consistency of growth, that's a good thing. The other larger point is the world is not going back to where it was in 2000. There is so much private capital available today. That's not going to change. It's not going to decrease. So we will definitely live in a world where companies stay private longer because they can. But it's important to recognize the end state for most companies will be a public market. And that is because in a public market with the exchange function, you have the best possibility of discovering the proper price because you let all investors in. When you start, you start with friends and families, you go through an A round, a B round, a C round, and then when you're public, you have literally thousands of investors on a global basis having access to your company. So that's a natural end state. So I don't worry about whether it's 4, 5, 6, 7, or 10 years. The fact is companies will become public, and we see that certainly this year.